It is with that I'd like to turn over the presentation to Ms. Lori Klein.
Thank you, thank you, thank you. I just found out this is not a microphone. It's recording on the website. So, okay. So if you can't hear me, please just say, speak up. You know, don't mumble. Hi, I'm Lori. And what I'd like to do in your outline and in your folders, does everybody have a folder? And good. This is an outline on a course that I do at Lone Star College. We are not going to cover every bit of that. We'll highlight some of the things, but I really want to make this informal. If there is a certain topic you want to hone in on, please just raise your hands, and I want to cover everything that is of interest to you. We also had our pens. I've got a great office manager. This is a level. It's also a ruler. It's a file. It is a deal for your phone. If you screw this cap off, it's a screwdriver. It's also a pen. So it's also a pen, but that's our gifts to y'all, so please take them. So we also have our part of ours protecting all parts of our clients' lives, and those are the credit card sleeves that your credit card cannot be read going through automatic scanners and such. So take those to put your credit cards in to protect. We had the FBI speaker from the FBI 20 years on cybersecurity speak for us last night at the college. And we have an active community outreach that we do. And one of the things that you may have seen is we have a shred event on Saturday. So bring from 10 to 1 at our office on 1427 Kiefer. Yes, I make the rest of my team, and there's 11 of us. All the guys are going to be out there, no muscle shirts. You're going to be dressed like Nanook of the North and pick up the stuff and throw it in the shred. But we also have the electronic shred that kills your hard drives and old phones and TVs under 30 and copy machines. So that is Saturday from 10 to 1. And you're welcome to drive through, put your stuff in. Kiefer Road is right behind Klein Funeral Home on Main Street. That's Main Street, and Kiefer runs parallel to that. So let's go ahead and begin. There's a lot of handouts in your folder, and I'm a big believer in information. So, but first we're going to talk about history of income tax. Taxes, that's why we became our own country, was because taxation without representation is tyranny. I kind of think that's still going on today, though. But what we have is the taxes that the first tax that was really started was in 1861, because after we became our own nation, tax was a really bad word. But in 1861, we had our first tax, and that was to pay for the Civil War. And it was 3% of whatever you earned over $800. Well, that lasted till 1872, just during that time. And it was Will Rogers who said the difference between death and taxes is that death doesn't change every time Congress convenes. And it does when there. The main tax that we had actually came about in 1894. They imposed a permanent 2% income tax. And it was 1895 struck down by the Supreme Court that it was unconstitutional to tax the American people. In 1913, that went out the window, and Oscar Underwood signed the 16th Amendment of the Constitution, and we had a permanent income tax in 1913. Woodrow Wilson. And what that was 7% of income. Your tax rate was 7% of income over $500,000. In today's dollars, that's $11 million. So if you made $11 million, you paid tax. The lowest bracket was 1% over $20,000. In today's dollars of inflation, that's $4 million. So our tax structure was to tax the ultra-rich, to help pay for wars. Taxation actually came about to pay for wars. World War I, 15% tax up to 77% tax rate. The Depression hit. 25% was the low, 63% was the top on top earners. World War II, that was the highest in the history of the United States. 94% tax rate of anyone who earned over $200,000, which in today's inflation is $2.5 million. So 94%. It was what the tax rate was. That was during Roosevelt's time. That's the highest it's ever been. In the 50s, 60s, and 70s, top bracket never dipped below 70%. In the 80s, top bracket was 50%. And then came Ronald Reagan. 1986, Tax Reform Act dropped to 28%. In 1988. Now he took away a bunch of deductions. So it was a broader tax base, but it made the same revenue as it did by taxing people at 70% because more people now paid income tax in 1986. From 90 to 2012, it was a 39.6% bracket that dropped to 35. From 2013 to 2018, it's a 37% bracket, but we had the 3.8% tax that helps pay for the health care under the health care bill. So the 40.8% is our top bracket. And now the brackets have changed. So that is one of the things you need to be aware of. If you look in your folder, I have income tax brackets. These, we have income tax brackets. Maybe in the very back. So. And the reason this is important is because you have a chance to pay 0% capital gains under these new brackets. So let me kind of explain how those work. First of all, let me make sure everyone understands this is a temporary tax. There were only 4 items affecting the individual that do not expire in 2025. The corporate provisions of lowering our tax rates down to 21% is permanent. The corporate provisions are permanent. The individual provisions are not. They go back to what they were in 2017 in the year 2025. And that includes all of these brackets. So all of the health, all of the individual. So the ones that were permanent was that the IRA limits and such like that, you have to index them for inflation. The phase-out limits, that if someone earns over this amount, they're not going to get this deduction. You have to increase those for inflation. The health care mandate, no longer are you penalized for not having health insurance. That's gone. Starts 1/1/19. If you don't want to have health insurance, that's your business.
But for 2018 taxes, they still have it.
Right. 1/1/19, no more penalties. Alimony. This alimony as of 2019, alimony is no longer deductible by the person who pays it and is no longer income to the person who receives it. Now, old divorce decrees you can take back to court and try to renegotiate things. The person who's used to paying tax on that alimony probably won't go, but that is, alimony no longer is deductible and is no longer picked up as income for 2019. The last was 12/31/18.
You're not saying there's any grandfathering at all. So if the person was ordered on alimony years ago, they're paying it for 10 years, next year it can just stop unilaterally, subject to no complications except the other side taking them back to the family law court.
Right, 12/31/18. And that was the end of it. And so we thought they would be grandfathered, but when the final provisions came out, which was in December, early in December, they said, no, your recourse is to go back to court and negotiate that.
Wow.
So that's alimony. Now, everything I'm saying too is subject to change too. December 2nd was the last day that people could write in about their feelings on entertainment, amusement, recreation, which are gone. So all of that, and then they were going to issue the new regulations by the 15th of January on all of these things. They hadn't told us exactly what to do. We're in a government shutdown. The IRS is supposed to open January 28th for filing. And they have called back half of the IRS workers to make that happen. But we are preparing the returns based on what we know. And if it is a really big issue, we may go ahead and file extensions till we get the rest of the rules. And that's kind of how preparation is looking like this year. So right now, I know that the legal lobbyists are not happy about that. So they were up there trying to say, oh no, that's, if you're grandfathered in, you ought to be grandfathered in. But what I'm trying to do. So back to the rates. If you look at the income tax rates, and single, it is $38,700. Once you reach $38,700, you're in a 12% bracket up to that time. Look at married filing jointly, it's $77,400. Now this is for 18, you're in a 12% bracket. Now go to the bottom and look at long-term capital gain and qualified income. They forgot to make these the same as the tax rates. So if you look, if you were in an ordinary income bracket of 10 or 15%, well, there is no 15% bracket. But if you're in a 10 or 15% bracket, which means you're in a 10 or 12% bracket, and that is your other income besides capital gains, you could pay 0 on your capital gains. So if you have a big land sale or something that you've got a large stock sale, which you did before November, then you had a big gain on, and you could make your income below these numbers by, if you're over 70 and a half, giving your required minimum distribution out of your IRA straight to charities, so you're not taxed on it, or maybe not turning on a pension. If you look at your income and try to make it below those amounts, you will not pay any tax on that gain. And that carries forward into 19 too. So it's a planning tool that you need to be aware of on this. After that, capital gains are 15% if you're in the 25, 28, 33, and 35, which there is no 28% bracket, there is no 33. And if you're over 39.6, well, that's 37, because there is no 39.6 bracket. You're paying 20% on capital gains and 15%. That is the same thing also on dividends. We still have a separate tax rate on dividend income, 15%, 0%, 15%, or 20%. So those are the rates that we have now. Standard deductions, they doubled them. Single used to be $6,300, and for married was $12,700. Now for 18, if you're single, your standard deduction is $12,000. Now, if you were over 65, you get about $1,600 more. $24,000 for married filing jointly is your standard deduction now. And if you're over 65, you get $1,300 more per person, which makes it $26,600 if you're over 65. So that's good, but he took away all exemptions. So if you have 3 dependents, you do no longer get an exemption for it. It's just your standard deduction. Now, to help people with children under 17, they expanded the tax credit. So if you have children under 17, you get $2,000 credit per child. And that helped a lot of families who lost that exemption. So you've got 5 children under 17, that's $10,000 of credit, not deduction, but that the IRS has paid in for you, and it's refundable. So if you don't use it, they're going to send you a check. And that's how they help. If you don't have children if they're over 17 and they're between 17 and 26 and in college, you've lost that exemption. You've lost that exemption. The other thing you lost in standard deductions is anything in miscellaneous itemized deductions. No attorney fees, no financial planning fees, no tax fees, no business expenses of W-2 employees. No your gambling winnings are fully taxable. Your gambling losses cannot be deducted. So everything that went under miscellaneous itemized investment management fees is gone. That whole miscellaneous section is gone. Taxes, property taxes for your home and your vacation home and your sales taxes are capped at $10,000. So if you have property taxes of $8,000 on your home, and you also bought a new car that has a $2,000 sales tax on it, well, you're at $10,000 right there. You're done. Anything over that is wasted. So this paying your taxes, 2 years. So I'll have $16,000 of taxes. That strategy may not work right. You have to relook at that because you only get to deduct $10,000 of property taxes on your first or second home and your sales taxes. So that takes effect for 18.
And is that something that's only good till 2025, or that's one that's permanent?
2025. All individual things are going away in 2025 unless extended before then. So, hold on. The other is medical. It's 7.5%. You get to deduct anything that's over 7.5% for 2018, 10% for 2019. So if you don't have a lot of out-of-pocket medical, and when I say 10%, you take your income, multiply it by 10%, you got to be over that to get any medical deduction. But you do get to count all of your premiums, and if you have long-term care, be sure and pull that. All of your health insurance and any out-of-pocket, including mileage. So, and remember your medical mileage. Interest, what they've done with interest. They have capped interest, mortgage interest deductions at $750,000 of debt. That includes your principal residence and your vacation home, or your second home. Now, that does not count toward your rental property. That's Schedule E. That does not count for a farm. That's Schedule F, mortgage on your farmland. This is just for your principal residence and your second home. That is not business in a business asset. $750,000 is the cap on the debt that you can deduct the interest. Also, home equities. And this has gone back and forth and changes, and the latest and greatest is on home equity. No longer can you borrow on your home or your vacation home to pay off the credit cards, college, accumulate debt. No debt consolidation interest is deductible. So how you used to borrow on your equity to do that, to pay off credit cards, pay for college, buy a car, whatever, no, that interest is not deductible. The interest that is deductible is on your residence. It's the one that is to acquire the residence. Now let's say you have a lot of equity, your house is paid off, and you want to borrow money to fix up your rent property. But you don't want to mess with putting your rent property up as collateral because it's not enough. You can still borrow on your personal residence and deduct that interest on Schedule E, even though your personal residence is the collateral. You can still deduct that on Schedule E. But the home equity loans have to be to build, acquire, or improve your residence. You can still do home equity, but they've gone back to the old rules. You got to use it for your house. You got to use it for your house, and then you can deduct the interest on that. Contributions, you can deduct 60% of your, you've got make $200,000, you can have contributions of $120,000 and deduct it. So, don't know what you're living on, but you could. 5-year carryover, The donations, you have to have anything over $5,000, you have to get it appraised on a non-cash. You must have an appraisal. If it's a non-cash charitable contribution is worth over $5,000. You also cannot deduct donations to colleges if you get season tickets. If you get anything back from your alma mater on season tickets or any other type of benefits, that is a non-deductible contribution. And they did that to tie into when they killed all the entertainment roles, all the entertainment. AMT, that's the alternative minimum tax. They have raised the limit, so we hope that a lot of only the high income taxpayer, well, high income according to the government, is going to pay alternative minimum tax. And what that is the government wants to make sure that you don't use all of the tax loopholes to pay a low tax if you are a high income taxpayer. They're going to hit you with a 20% minimum tax. It's you may have seen it on your tax return, 2 calculations, and you see that little increase to get it up to that. But they've raised the limit. That used to be $40,000 of income would trigger it. Now it's $109,000. So they have raised that limit.
$109,000 for a married couple?
Right, per person. Child credit. I talked about that. Health care taxes, HSA limits. I don't know how many of you do health savings accounts, but they have raised the limits to $7,000 for 19. You have until April 15th to make your 18 contribution. Family, it's $6,900. Single, it's $3,450. We've talked about capital gains, and then at the bottom there is the mileage rates for 18 and the mileage rates for 19. And don't forget to accumulate your charitable mileage. If you involved in committees at church, if you're decided to take on the campaign to raise money for your church or a charity, all the mileage you do, keep track of that. The charities are 14 cents. They didn't change. Medical increased to 20. Business mileage increased to 58 cents. So, but remember, if you're a W-2 employee, where you're used to deducting that mileage on miscellaneous itemized deductions, no more. You go back to your employer and you set up what's called an accountable plan, which says, dear employer, I would like to turn in my mileage monthly and get reimbursed. You know, and if you own your own businesses, set that up in your own businesses, because it's no longer an add-on coming through the K-1s anymore, that there's some expenses that you had that you didn't get into your business by the end of the year. It's early enough. Don't close out your books. Get your mileage and get reimbursed for that through your company and take it as a business expense. So,
Lori,
yes.
explain that a little bit more. So, if your company, your law practice, you're tracking all your miles to the courthouse or whatever, and the company is reimbursing you every month,
You're okay.
then that's a business expense. But if you were just going to write it off as a miscellaneous and not be reimbursed, then it's out.
It's out.
Okay.
They took that whole section and erased it all.
Okay.
So, and that includes entertainment, meals. Here's the deal on meals. You can invite all your clients to the baseball game and buy them tickets and skyboxes and all that sort of thing. You can't deduct any of that except 50% of the hot dog. So you can deduct anything that is consumed for business of meals and food and drink, as long as it's not extravagant and it's invoiced separately. You get a 50% deduction. So the entertainment, they went after country club, no country club dues, no season tickets, no fishing, no hunting. You can rent a boat, take your clients out fishing, that's fine, but the only thing you get to deduct is 50% of what is eaten and drank. Yes?
Is that approach applicable to both individuals and corporate entities?
Yes.
Okay, thank you.
Yes, and that's the one that the lobbyist had kept it open to get the comments December 2nd to bring back, because the attorney for the tax committee, the 200-man tax committee that is coming up with these rules, did not mean to kill our client parties, did not mean to kill our employee Christmas parties or employee get-togethers. They did not mean to kill that. And so we think they're going to bring back a client appreciation event, one of those a year, as long as it's not extravagant, and also your employees events to build your team. Now, if it's at your office and you bring in food and drink and stuff, it's still 50%. It used to be 100%. It's 50% on the meals. You only get 50% deduction on that. So hopefully we will get some, if you have big travel and entertainment, you may want to work up your taxes and then see, okay, let's wait until we get the final. But hopefully we'll have it by March 15th, which is the due date of most of y'all's taxes. That's partnerships, corporations, trusts, March 15th. April 15th is C Corps. They changed the dates. This is what it was last year too, but March 15th is a deadline for businesses. So the entertainment, what is, okay, you take the skyboxes. Now we're seeing the companies go, well, you're not renting the skybox, but the price of your food just went up. Oh, the IRS slammed down on that in a heartbeat. They even have it in there. It said, you cannot increase the price of the food to cover the event. So that's not going to work. Now what will work, all the names around the sports things, and that's what you're going to see the large companies do, is sponsorships and advertising. This is not entertainment, it's advertising.
Right.
You're going to see nonprofits start changing the way they promote their golf tournaments. Now it's a little late for 19. They've already kind of got a lot of that in play. But you sponsor a foursome at golf or a Lone Star College, that's not deductible. What they eat and drink is. So you're going to see charities, which are going to be the big losers in this. You're going to see charities figure out another way to bring in those corporate sponsors, those business sponsors. And on an individual, when you do it on an individual basis, then you have to deduct from your cost the fair market value of going out and playing golf at that particular course. And so you're going to see a lot of things shift from businesses, well, most of them, to the individual, which means you're going to be paying for that with after-tax dollar. You've got your money you pulled out of your business. Now you're going to go to charities. Yes.
And I hear you just say that indirectly or directly, that whereas entertainment sort of went out the window, but even if you call it advertising, instead of taking your friends to a ball game, you send clients to a ball game as a form of advertising, you're still SOL.
You are, because
I thought that's what I heard. I'm pretty sure.
right, to deduct the food, you have to be with them. You cannot just send your clients. You've got to be with them. So you've got to go to all the entertainment visions or fishing or hunting or whatever you have set up. And this is for corporations, all corporations. So a lot of the major publicly traded have already cut down. They cut down on the entertainment, and they're pretty strict about all that anyhow.
The NFL and all of the sports teams must be
They are.
furious.
That is why they had it, that part of the law doesn't have the final regulations, because they were able to keep it open for comments till December 2nd, and they all came in, and then the government shut down. I hope somebody's read them. I don't know if they have or not. But that's what's going on with the entertainment. Tax rates, corporate tax rates. The tax rate for C Corps dropped to 21% flat rate. So that is a major change, and that is what we had to do here in the United States. We had to lower our corporate rates. We had lost about 90 publicly traded companies, moved out of the U.S. to get out of the highest taxation in the world. Walgreens Boots. You know why it's called Walgreens Boots? Because it's an English company. It's not a U.S. company. It's English. Now, in doing that, they lost the Medicare contracts, so they've kind of, CVS was happy, but so we had to bring our corporations back. And this is the compromise why the personal all these personal changes expire in 2025 to get the corporate rate permanent. So we have a 21% flat corporate tax rate for C Corps. Now, S Corps, partnerships, trust, rental property, oil and gas partnerships, any other business, they came up with what's called qualified business income deduction. That in order to give you some parity to the C Corps paying 21%, whatever your net profit is, you get a 20% additional deduction on your personal tax return. Except if you are a specified service business. And attorneys are, and CPAs are, investment management, health, law, accounting, actuaries. They went after actuaries. Performing arts, consulting, athletics, financial services, brokerage. Then they came up with the broad definition, any business that the reputation or skill of one or more owners, that is a specified service business. And they do not get the deduction if the income is over $315,000 for married filing jointly and $157,500 for single. They only want to penalize the people who make a lot of money. If your taxable income, married filing jointly, is $315,000 or less, you get the 20% deduction, even if you are a specified service business. But if it goes between $315,000 and $415,000, it phases out. And if it's over $415,000, you don't get anything married filing jointly. It's $214,000 for single. And this is taxable income, not adjusted gross. This is after your itemization. It's taxable income.
Taxable income is over $315,000.
For married filing jointly, yes. It phases out between $315,000 and $415,000. So, and that is and that is rent property. You have profit in rent property. And you have profit in your business. You add them together. And you get 20% of that. It does not count any W-2 wages. So those with S Corps, you have to give yourself a W-2. And we kind of work on a ratio. If you make $300,000, then you need to have about $100,000 W-2 and $200,000 in draws that you don't pay Social Security tax on. You don't get the W-2 income with a 20% deduction, but you do get the $200,000 of a 20 times 20%. It is a complicated calculation because they also have some limits that if you don't have a W-2 and you make over $315,000, you can deduct up to 50% of your W-2, but if you don't have a W-2, that's zero. So there's some tax planning for S Corps that you needed to look at for 19 especially. 18 is the first year of it, and that is when you get your taxes done, then you need to sit down with your CPA, your tax preparer, and say, okay, what could I have done for 19 that would help me take advantage of this new law? Not take advantage, that would help me tax plan. Don't use those words, take advantage. Tax plan, that would help me tax plan. So sit down with them once you finish your tax return for 18 and say, okay, let's lower this, let's raise this, let's put this over there. You know, look outside the box to see what you can do to be part of this new tax law to help you. And that's the qualified business income deduction. It's a deduction that's part of the W-2, but let's say you're real estate and you've got big equipment or you're manufacturing. Then you can deduct, whichever's higher, 2.5% of the equipment you purchased this year instead of the 20%. So there's lots of ifs, ands, and buts on that calculation that actually is a whole course on itself with charts and graphs, but I want you to be aware of that qualified business income deduction if you have a partnership, rental property, farm, and they combine all of these businesses together. If you have a loss here and income here, they're going to combine it together. So if your losses outdo your income, you're not going to have anything because there's no deduction if you have a net losses on your business. Anything. So And a good way to have losses is the new 100% bonus depreciation. They have expanded repair and maintenance $2,500. Anything that is $2,500 or less on any repair and maintenance, expense it. Don't bother setting it up as any type of asset. You can expense it. If you have audited or reviewed financial statements, you get $5,000. That's called applicable financials. You get $5,000. They expanded the depreciation. You buy a piece of equipment for your work, you need a backhoe, or you need, well, y'all don't need it, but clients, but some piece of equipment, then you can bonus depreciate 100% of it in that year. So you can, and that is a way of lowering taxes. So they also raised the section 179. If you have a farm and you need a tractor, you can take 100% of that and have a nice farm loss to offset your other income. Well, the IRS, the tax people who wrote it, said, ooh, we have created a problem by giving 100% write-off of that. We're only going to let you take $250,000 of losses like farm against your other income. For married filing jointly, it's $500,000 of losses against your other income. And if you have a net operating loss, you're going to lose 20% of it as you carry it forward. So they gave us all these great deductions, but then they put a limit on them. So keep that in mind too.
I thought this was supposed to be postcard taxes. Isn't that what they said?
It's supposed to be what?
Postcard? Like
Oh, yes. You do have a postcard. You will get it's this big. And what they've done is taken the first page of the 1040, taken a bunch of lines out of it, like the Schedule A deductions, the Schedule B deductions. Now you have a postcard front page and 5 schedules. Schedule 1, 2, 3, 4, 5. Schedule 1 is your itemization. Schedule 2 is your interest and dividends. Schedule 3 is your capital gain. So it's the same thing. It's just that what used to fit on 2 pages now is going to fit on 6. But the front page is only this big. So it's embarrassing. I cannot believe they thought, yeah. But so that's the postcard. There's no more 1040As. There's no more 1040EZs. So if you have a child that just has income in your filing, they're your dependent, or even if they're not, and it's just a W-2, you file the postcard. You know, that's what, because there's no more 1040As or 1040EZs. So some of the other items, I know we just have a few minutes left. No more like-kind exchanges on automobiles. You know how you used to trade in your automobile that you use for business, and you used to then reduce the basis of your new automobile? No more. Like-kind exchange are only for real estate. You cannot do any personal property like-kind exchange. So if somebody who just bought a new car, on their old one they got a $40,000 trade-in, sorry, that is a taxable gain. You sold it for $40,000, it was fully depreciated, you've got a taxable gain. Now the new car is $60,000 that we set up, but we can take a bonus depreciation 100% only if it's over 6,000 pounds. 6,000 pounds are the big old Suburbans. Look on the door of the car and see what that net weight is. And if it's over 6,000 pounds, it qualifies for 100% deduction. If it's not, then it's going to be about 18,000. It's called a luxury automobile limit on depreciation. So don't go think that right at the last minute you can buy a new car and get 100%, because it's got to be over 6,000 pounds or for a farm vehicle and like a piece of machinery, but it's got to be over 6,000 pounds and through there. We talked about like-kind, NOL carrybacks, bonus, cost segregation. Cost segregation is back. Because of the enhanced depreciation with bonus, if you own a building, or if you have a building that is not built in the 80s like ours was, it's too old, but if you own a building, there are companies, and I put the name of the one that we use here, that specialize in going in and segregating your HVAC system, your roof, your heating, your alarm system, your fire system, actually breaking down all the components of your building. And those can qualify for a shorter depreciation or 100% depreciation. So it's called cost segregation to give you a bigger deduction. Use that in a year that a business is sold or that you're getting a big windfall from a case or something like that. If you have a building, if you own a building, you have to own the building. It doesn't work on leasing something. But cost segregation is back, and there's companies that specialize in that now. Estate and gift tax. Income tax. My master's is in estate and gift tax, so I love working with attorneys on all this because it's interesting in that we now have 11,400,000 apiece in 19. You have a couple that can be worth $22.8 million, and their heirs will not pay a dime of estate tax. So that has changed a lot of the estate planning, the old family limited partnerships and the gifting out and a lot of the wonderful documents y'all draw up. It has changed some of them, and because a lot of people are way below those limits, that covers. But remember, this also goes back to the 2017 limit, which is the 5.2 million per person in 2025. So it's estate planning in the interim. What do you do? You have the income tax rates if the trust, in the trusts that are drawn up, if they are complex trusts, they must distribute the income from those trusts within 62 days. The 63rd day, which is coming up usually March 2nd, something around there, and then that counts as a distribution in 2018. Because when the trust reaches income of $2,500, they're in the 24% bracket. And when they reach income of $9,000, they're in the 35% bracket. That's in the complex trust. The simple trust, there's deemed distributions on the simple trust, but not in the complex. You have to actually distribute the money in order to avoid the trust high bracket. Now, if there's not any tax, there's not any profit, you don't have to worry about it. But in drawing, we go back to the trust documents that y'all draw up and say, are these simple or are they complex? And that does affect the taxation. Estate taxes, portability. Portability rules are, if someone died and they did not use all of the exemption equivalent of the spouse to die, you could file within 9 months of date of death on a timely filed 706, check the box that says, take whatever my, I'm going to kill off the husband first, that's statistics, nothing personal, but I'm going to take my husband's exemption equivalent that I didn't use up, and I'm going to add it onto mine. So now I can be worth 11.4 plus another 4 million, whatever it is. A lot of people miss that because it was kind of new. You don't have to file the whole 706, but you had to be filed within 9 months of date of death. They've now extended that for 2 years. So you can file that portability election to give that portability to the surviving spouse that they could be worth a whole lot if you have the 706 filed by 2 years from death. And that was a change in the law, which helped a lot because land went up, bypasses come in, son, your $300,000 property is worth $30 million. And you don't know what's going to happen 2 years after death. So you have some leeway for the surviving spouse there, just to be aware of that. Roth conversions, you can't characterize a Roth conversion anymore. Say you had an IRA. You say, I'm going to make it a Roth. Okay, fine. Uh-oh, I can't. It's going to cost me too much. I want to do a do-over. Those are gone. You can't do that anymore. You also be careful of the backdoor IRAs. Say you make so much and you don't qualify for a Roth. And so what you do a non-deductible IRA. And there were a lot of brokerage houses that had to pay a lot of penalties for their clients because somewhere in their corporate offices, they were telling their agents to tell people to do that to get non-deductible IRAs. And then that non-deductible IRA, you convert to a Roth. Well, there's something called the aggregate rules. That's okay, it works if you have no other retirement income under any 401k or regular IRA or other Roth. Because if you do, then it's called the aggregate. You take that conversion over your total amount, and it's only that small percentage that you don't pay tax on. So a lot of people I had several clients and said, why'd you do this? And he said, because, they said it's a good planning. Well, here's what you owe in tax. It didn't work. So be careful of those. Always check that kind of, if it sounds too good to be true, there is a catch somewhere that could get you without doing your research. 529 plans. If you want to set up, everyone know what a 529 plan is? Putting money away for education for your child, your grandchild, all the way down to first cousins. They have expanded that. It can pay for public and private schools, K through 12, up to $10,000 per student. So public or private schools. So you can help fund your grandchild or your child's private school through 529s now. And in the Brady Bill 2, that hopefully will pass, he's expanding that to pay off student loans. He's saying the part of the permanent deal on discharge of student loans, yes, you can get your student loans discharged, but the price is pretty high. They have to be permanently disabled or dead, and then you can get their student loan discharged. So if a child passed away and had student debt, it's discharged.
That's government and private?
That's government, Are permanently handicapped. That's it. That's how you get your student loan discharged right now. So the personal property, your employees. You know how you used to give coupons or maybe some cash in a Christmas card or something like that to employees, or gift cards? No, none of that anymore. If you want to, anything you give to your employees, you have to add to their W-2 and let it as part of a achievement award, and then you give them a catalog where they pick their gizmo that they want to buy up to a certain amount. You cannot do trips, cash, started in 2018. Cash, gift cards, coupons, trips. You can't do any of that. All of that is supposed to be added to their W-2. Now, do I think anybody did that? No, but, but oh, is this on tape? So, but you can't erase it. Okay, but that is the rule that started in 18, and it has to be part of an achievement award. An achievement award. The small business health reimbursement is back. And I have a handout for you that gives you all the rules on how you qualify to set up a health reimbursement arrangement for your employees. The limit is $5,150 for a single person, $10,450 for married filing jointly. So, and that's in 2019. But it did come back in 2018. So you may have people asking you to draw up those agreements. And in your handouts, I have the rules for the qualified self-employed health reimbursement account that they have brought back. That was that old Section 115 stuff that we did years ago, and then they killed it and they brought it back with limitations. And it's so, especially since you don't have to have health insurance anymore. It is a way of providing to your employees a reimbursement for some of their health care costs. There's restrictions on the owners. You do get some, but there are some restrictions on more than 2% owners. Personal residence, 2 out of the last 5 years. You must live in your house or homestead it 2 of the last 5 years. Okay, you move away to independent living. and you turn your house into rent property. You've got to sell it. You only have 3 years that you can rent it before you lose the personal residence tax exemption, which is $500,000 of profit selling your house, married filing jointly, that is tax-free. $250,000 single, that would be tax-free. You've got to live in that house and claim it as your residence 2 out of the last 5. It doesn't have to be the immediate 2. So keep that in mind on personal residence planning. And then also step up in basis. Titling of accounts, gifting things. Mother decided to gift her house to her son, okay, or gift a rent property to her son. Remember, the gifting means the basis of the mother or the father is what the recipient's cost basis is. We are one of the 7 community property states. Y'all know all this, but we have step up in basis. So gifting, you don't get a step up in basis. Inheritance, you do. I think the trust code changed, one of the attorneys we deal with said, yes, payable on death, transfer on death, you get a step up in basis. What that means is the cost basis of that stock or that real estate is the fair market value on death, not what they paid for it 20 years ago. And so when the heirs start to sell it, that gets them out of all that capital gains. It's the day of death is an important basis, and you don't get it if they gift it away before death. Yes?
So the transfer on death deeds that came in a few years ago, basis.
On death, yes, that gets what? That's why they transfer on death, payable on death, those get it. Joint tenancy with right of survivorship, 1/2 gets a step up, not the other half. Only 1/2. So the default in brokerage accounts is joint tenancy with right of survivorship. And you have to watch those. A lot of those are coming down from states that don't have community property. They don't deal with this. Texas, it's a great advantage of being here in Texas, is the step up in basis. And there's so few states that are community property states that have that the laws are not made for us. You have to watch to make sure it's not messing up this step up. So if you see one of your clients with a joint tenancy with right of survivorship account, that means it doesn't go through probate. So the decedent's half can get a step up, but not the other one. So you only get half of a joint tenancy with right of survivorship step up. We've had to deal with, okay, which assets will go into the non-step up brokerage account and which assets go through the step up brokerage account. Okay, let's figure out what was paid for when, and is this ever going to be sold? Are you ever going to sell this Exxon stock? No. Okay, you've got a small basis. Let's put that in the non-step up because they're going to inherit it anyhow. So watch the titling of that. But transfer on death, payable on death, all that is, you do get a step up. And watch in deeding things out of the estate. If it is, say the husband died and she wants to deed the rent house a month, a year later, her cost basis is the day of death of the husband. So it may be fine, but be sure and check that before just deeding out. And we used to have to do a lot of deeding out because the estate limit was so low. It's $11.4 million per person. so planning changes with the taxes. So now if you're trying to qualify someone for Medicaid, there are attorneys that specialize in that, and that is a whole different area that we can. Some of you do Medicaid planning?
We have a couple people, but they're not here tonight.
Okay, because we work, attorney that's your specialty is Medicaid and VA planning, and it works. So that's a different ballgame. Or if you have a disabled, setting up special needs trusts and stuff. Is there any other questions? I know I kind of run through it pretty fast. You have my contact information, email, and if there's ever any questions that you have on anything, please don't hesitate to get in touch with me. We are, been here 35 years, and we have, you know, so many of you, I look and say, I know you. Yeah, we
Would you have any last questions for Lori? I know I learned a lot. Lori, this is just a small token of our appreciation for you coming and seeing us.
Thank you so much. Thank you.
I
enjoyed
appreciate you
it.
coming. I know it's a long day for everybody, but this was very, very helpful for both my practice and my business.
Right.
So thank you for coming.
Well, thank y'all. We appreciate all that y'all do as attorneys. We do. I mean, between, you know, the attorneys, the CPAs, and then financial planners, we have our clients' lives in our hands, and we appreciate what y'all do. I do. I don't ever want to do that. So, my sister's an attorney, but my brother and I went into CPAs, and she said, that's because you can't spell. I said, that's right. It's true.